Welcome to the Fintech Times News and Views podcast. Established in 2016, the Fintech Times is a global multimedia news outlet centered around the world's first leading fintech newspaper. We report on the latest and brightest ideas from the fintech world. Follow the conversation using hashtag TFD News and Views and follow us at the Fintech Times. Hello, and welcome back to the Fintech Times News and Views podcast. It is a brand new week, and I'm here as ever with Francis and Tom. How are you guys doing this week? What's up? What's been happening?
It's good to be back. It's been a good week, I think. We've been plugging away, getting through the news. We've had some interesting news come in this week, and yeah, nothing crazy been happening, but it's a good week, and I'm looking forward to the podcast today.
Love that. And Francis, how about you? How you doing?
Yeah, I'm good. Sometimes we get some news in which is, I don't want to say standard, but it doesn't really, it doesn't excite us that much. But we've had quite a lot in this week, which I've thought has been really good. So I'm looking forward to discussing some of it with you guys today.
Awesome stuff. And speaking of that amazing news, what are you guys going to be talking about today? Francis, what are you bringing to the table?
So today I'm going to be talking about Curve and how it has launched a referral program to enable consumers to double dip on cashback.
Lovely stuff. And Tom, how about you?
I'm going to be talking about our first article in our embedded finance monthly theme.
Lovely stuff. And this week I'm going to be talking about some new research talking about securing Gen Z loyalty. So Tom, I'm going to pick on you to go first because I have been talking a lot about embedded finance this week, obviously being our theme. So let's kick off with that.
Well, yep. So as you said, throughout April, the monthly theme at the Fintech Times is all things embedded finance, which is obviously the integration of financial services into non-financial products. And one of the reasons we decided to take another look at this topic this year is just because of the rapid growth of embedded finance offerings and how it's changed and how people interact with their everyday finances. And now, according to the latest Juniper Research report, the global embedded finance market currently boasts a transaction value of around $92 billion. But by 2028, it forecasts this value to hit around $228 billion, which is around about 148% growth in the next 4 years. So with this in mind, seeing this sort of huge potential growth that could happen in the near future, we reached out to experts in the space to find out how they expect embedded finance to evolve in the next year or so that will enable this lofty growth. So one really popular suggestion was that incumbent banks are going to really start moving into the embedded finance market, with the likes of HSBC making their first move into the market. A number of experts also recognize the importance of partnerships for the embedded finance market. So, for example, Adam Edwards, who's the product and growth director at cash management firm Satago, explained that Barclays has already partnered with Amazon to offer more embedded finance options to consumers. As we know, Amazon are often in the sort of forefront of innovation in this type of area. And he also explains that these types of partnerships enable customers to take advantage of the trust that they have in banking providers to access finance in a reliable way, with the benefit of a wider and more flexible suite of finance options. And obviously, we speak a lot about the sort of importance of trust, particularly with incumbent banks and consumers, and how they can, even though they're not necessarily innovators, end up leading the way in most of these spaces. And that seems like a trend that experts expect to see in the next year or two. And we've also heard a lot about how embedded finance can help the underbanked and the underserved gain access to finance more easily across the globe, and how it can basically drastically enhance the user experience and make it more seamless. But this is really where I wanted to hear more from both of you. I'm interested to know what kind of comes to mind for you when you think of embedded finance, and what are the areas that you think it could really impact the most sort of across the globe. Polly, what do you think?
Yeah, it's really interesting. I think embedded finance is one of those topics that comes up time and time again just because it just keeps staying relevant. And I think, the other week I hosted a webinar for the Power 50 talking all about embedded finance with some industry leaders, which you can go watch right now. And it was so interesting to hear these industry experts kind of talk about kind of the embedded finance landscape. And I was kind of talking about kind of what the future is and what we can expect to see from it. But they were pretty much all saying, like, embedded finance is already here and it's already making so much of a difference in so many waves of this industry. And that's so intriguing to me. And I think as well, speaking from like a consumer standpoint, I love how embedded finance does really just make things so much easier. Like you were talking just then about sort of like financial inclusion and as well as like customer journeys and things like that. And, one of the things we talked about on that webinar was kind of whether embedded finance is going to be more of a good thing for the consumer or the business, when actually it's both, because from the consumer side of things, you get a really easy customer journey. Everything is there in one place. Thinking about things like Uber, you know what I mean? It's all done for you. You don't have to think about anything to make a payment. It's all just there in the same app, and you can just go, which is really convenient from a consumer standpoint, obviously, which is why I think it's so popular. But then, on the flip side of things, you've got the businesses which are taking advantage of this and helping keeping their customers and helping keeping their payments and innovating in that way. So I think it's really an interesting space to be in right now, and one that I think is coming up time and time again, in all over the place, like you're saying, like it's all over the world, and it's really helping to boost different things in terms of like financial inclusion and access to certain products. And I think just having these offerings is really going to start to be an integral part of business moving forward. If not already, like, you could say there's part of that that's already, especially with the rise of like super apps and things like that, and even just like general apps as well. Anytime you have to make a payment on an app, it makes sense to keep that payment within the app rather than having to, open your banking app and da 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 da. So I think it's just a really interesting space to be in, and something that's always quite exciting to watch. And I think there's just so many benefits to embedded finance that it just makes sense for us to keep talking about it again and again and again.
Yeah, like you said, I think the concept of super apps is something I looked quite a lot into last year. With the sort of suggestions that Twitter/X was going to roll out some sort of payment options, and they've definitely taken steps towards that. And just the idea of how super apps kind of took off in Asian markets, but not really in European and Western markets. But the kind of idea of embedded finance is almost like bringing that concept back in, but with like a different angle. So you're not seeing the likes of Alipay or whatever really dominate a space, but everyone is actually slowly just kind of adding things to their arsenal and ensuring that they can offer as many different financial products and services through their platform as they can. And like you said, I think it obviously has benefits for both the merchants and the consumer, and it really just is progressing this idea of a seamless experience where whatever platform you're on, as time goes along, they all become more and more of a one-stop shop. And it'll be interesting to see how that sort of space, particularly competition between different platforms, sort of pays off and continues to sort of happen. So I think it's a really interesting space, like you said, and there's a lot of sort of reason, like you said, to keep coming back to it. And I'm just interested to see what happens in the space, because it seems like you said, it's already here. We engage with it every day, and we don't really necessarily even think about it. So the more that continues, I think the more we're kind of going to get out of it. But Francis, what do you think? What do you think about when we mention embedded finance?
I mean, first and foremost, I think sort of just building on what you guys have said, it is really cool, and sort of the way that it is already a part of our lives and we don't seem to realize it. I think that is, albeit a little bit unsettling to an extent, it is quite cool that it is already taking hold as strongly as it is. The one thing that, well, there's a couple of things that I got from the article really, but I think firstly, I think it's really cool that there's this idea that, incumbents are catching up. Be that for the better or for worse, because I mean, you could argue, like, as a startup fintech, one that has sort of enabled, these seamless transactions before, who are like specializing in payments, that embedded finance might come as a bit of a threat almost, as it is almost removing that need for a third party to make things simple. However, I do think it is going to build on this idea of consumer trust from a consumer perspective, that if your incumbent is dealing with embedded finance and they are taking these next steps to really digitize themselves and sort of be aware of the trends that are going, I think as a consumer that sort of gives you a lot of confidence in your financial provider. The one thing that I thought was quite interesting is this idea of financial inclusion, because when I hear financial inclusion, I always think of the unbanked really, and those who don't have access to financial services. And I think one of the biggest points raised within the article comes from Kathy Stairs, the Executive Vice President of North America for Provenir. And she says that for embedded finance to be successful in 2024, providers will need to implement a cohesive data strategy by looking beyond traditional credit data, as it's rarely enough to paint an accurate, holistic picture of a customer's credit worthiness. And I think that really that's my biggest takeaway from it really, is that there needs to be for it to be as impactful as we all want it to be, traditional means of data to analyze creditworthiness, it needs to go beyond that. And I think once you can really sort of look beyond, bank statements and stuff like that, that is when you can really bring in other people that, don't have access to bank accounts into the picture, and really let them prosper in the new digital world as well.
Yeah, definitely. I think you're right there when you say, it's something we talk about a lot is the importance of utilizing data better than we do now. I think the sort of traditional systems, in many cases, when it comes to traditional banking, just aren't really up to scratch anymore. And we are seeing a sort of implementation of better use of data, but still not the ideal. Even, the sort of digital banks with new offerings, which are a bit more agile in using this kind of data, are still not all necessarily utilizing it as well as it can be. And I think there's a lot of space for that. And hopefully the sort of evolution of embedded finance just overall can have an impact on that and create more competition and therefore create more innovation and advancement in the space. So yeah, I think it's an interesting topic, and I'm sure it's one we're going to be coming back to not only this month, but through the rest of the year and beyond. But with that in mind, who wants to move on and take us into our next topic?
Yeah, so my article today is all about Curve, the digital wallet, as it has announced a new Refer a Friend program with new incentives. And whenever I hear these Refer a Friend programs, my ears always pick up. I think they're great. And I remember when I first signed up to a crypto company, I was trying to get all my friends involved because I was like, listen, you can be a winner, I could be a winner. It's almost like a pyramid scheme, and it might be a little bit concerning. But in all seriousness, I do think they are very, very cool, and they can help. They can help brands and consumers. Everyone can really be a winner from them. And the reason that I thought this article was so interesting is that the new Curve referral program offers 1% cashback on all spending, allowing customers to receive cashback for 30 days for every friend they successfully refer to Curve. There is no limit on how many referrals a customer can make, and in turn, this means customers can enjoy up to £30 every month in cashback or £360 annually. Free money. The new 1% cashback earned is a new perk on top of the previous rewards customers can already earn from banks and credit cards linked to the Curve wallet. And I think this is where the offering really sort of stands out, is because the potential of the Curve referral scheme and something called double dip rewards, which is essentially when you're getting cash back through two different means. So customers that link their cards to their Curve wallets or their bank cards, I should say, in an app, and they pay through the fintech to receive cash back, they get that on top of any cash back they're already getting from their bank or credit card. And this has been very well demonstrated by Chase UK, as the UK regulated bank is currently one of the strongest cashback offers in the market with 1% on all spending for the first year. When you blend this with Curve's referral program, customers can earn up to 2% cashback on all of their spending by linking their Chase card to Curve and referring friends. And with a monthly cap of £15 on Chase and £30 on Curve, that could amount to £540 a year in free money. And again, the reason I wanted to talk about this with you guys is because we've spoken about the idea of incentives, I think 2-3 weeks ago. It was pretty recently. And we were talking about how much they can really sway you to at least just try a new service to see what it's like. I mean, free money is free money. Why would you ever say no? So, to be honest, Polly, you were the first one that I wanted to come to here, because I remember you were saying when we were talking about what's going to make you stay loyal to a brand, incentives was like a big thing that you discussed and brought up. So I thought this article would be really interesting as like a follow on that as well, and sort of see how impactful do you really think sort of double dipping can be, this idea of cashback on cashback.
Yeah, I was definitely, as you were talking through then, I was thinking about, was it a couple of weeks ago when we were talking about the incentives like you were just saying, and how, yeah, who doesn't love free money? Like, let's be honest, it free money. Like, there's nothing really you can get there. And I think referral programs are a really interesting incentive, and I think they're very clever in terms of marketing, in that there's kind of like a no, there's no downside to them, because the person who is doing the referring is getting a little bit of a reward, whether that's money like in this cashback, or whatever else it might be. And then, the person that they have referred gets to sign up to a financial product or whatever it is that they're signing up to, and maybe they find a new thing that they like, and then the business gets more customers. Like, it's literally just like a win-win thing, and I think it's such a clever marketing technique. I love this curve idea in terms of the cashback and that being the incentive, because cashback always feels like everyone loves cashback, don't they? I think it was a couple of years ago, it was like the companies like Top Cashback and things like that were doing the rounds, and everyone loves the idea of you spend money and then get some money back because it's fun and it's free money again. So I love the idea of the cashback and this double dipping thing again. It's all just a fantastic marketing technique here to make people interested, because now I'm immediately interested in this situation because I like free money, and the fact that you can get quite a lot of money back. But I think the cashback thing is quite clever as well, because obviously to get the cashback you have to use the actual service sort of thing. So you can't just like claim the reward and then delete your account a couple of months later. You have to actually actively use the service. So obviously that's going to be good for Curve as well. So I think, there's a lot of things to say about this, and obviously that you said when we talked about this previously, it is a bit of a sticky time for a lot of people when it comes to finances. And I think I saw, was it the other week, that we were or are officially in a recession. So obviously it's going to be quite difficult for a lot of people, and little things like this really do make a difference when it comes to your bills. Having an extra £30 a month that you get purely just because you've already spent the money and you've got a friend to download the app, that could be a very big difference to a lot of people between paying their bills or like getting food, things like that. I know that sounds extreme, but it's true, and I think it's a really nice thing for a company to do, even though obviously it's all part of a company's strategy. At the end of the day, it's still a good thing to do, and I think it shows a lot of care for your customers as well. And that's the one thing I think incentives do that I don't think we necessarily talked about last time, was that kind of, it does show that you've got some care when it comes to your customers, and you care about your customers and what they've got going on. And that, I think, is a really big differentiator when it comes to like who people choose to do their business with, because you want to feel like people care about you. And I know we've talked a lot about people love having personalized experiences nowadays, people love having tailored experiences. Consumer demand is the biggest driver for any company, and customers want to think that they're special. Customers want to think that you care about them. They're not just another number. They're not just another, pay subscription charge or whatever it is that they're paying you, the company, to do. So having programs like this, I think, really helps with that consumer loyalty and really helps to show that you have care for your customers. So it's just win-win. It really is. I can't really see a downside to this. I don't know if you or Tom do, but things like this I think are really great to see, and like there's no way that you can see a negative to it. So yeah, it's great stuff. I love it.
I do really like it, and I like this idea that you're saying that it really does show care. But I think I don't know if it was what you were saying just before that, but it almost struck this idea of an excitement of, oh, I'm going to get money back, and you're only getting a fraction of it back. So then it's a question of, do you start recklessly spending to make the most of a service, and then is that a due diligence thing that these firms need to make clear, that they say, yeah, you're getting cash back, but that doesn't mean that you're going to get all your money back. It's not this for the 540 that you're going to get. You need to be spending well over £5,000, really and truly, to really make the most of it. And I do think it is very cool, and I do think that it is a really big thing to sort of show care, especially like you said, at a time where we are going through a difficult economic situation right now. And I think when a firm is still saying that we're going to stick true to our values and offer you cash back, I think that's really good. But I don't know what it was. I think it was just the excitement there of, now I want to try it. It just made me think, well, actually, yeah, I would also want to try it. But to get the most out of that cash back, you've got to be spending a lot. And then, like we just said, in a tough economic climate, is that really what you want to be doing? So I don't know. Tom, do you have any thoughts on that, or any thoughts on the article, or separate thoughts on the article?
I mean, I do really like the incentive, and I think it's a good initiative to try and get people involved. I do see what you're saying with the idea of, people could maybe get caught up in the idea, but at the end of the day, I think most people are going to recognize that it's, 1% cash back. I know Chase Bank did something to try and get people to open accounts with them, maybe last year or the year before. And I know plenty of people that engaged with that and thought, oh, if I make any big purchases, I'll make sure I put it on that card because I'll get a percent of the money back and it all adds up by the end of the year, things like that. So I think it's a good initiative. I think in this case, I really like the idea. I like the concept. It encourages people to sign up, and it also gives them something back in return for signing up. And it really does feel like a sort of everyone wins kind of scenario, which is sort of reminds me of something I saw. Was it last week or the week before? I don't know if you guys would have had this, but on my Twitter timeline, I just had people spamming this Timu referral program link and trying to get people to sign up to Timu because they make money if people click their link and refer them. And people were making in a couple of days, like people with thousands of followers were getting people to sign up and were making hundreds of pounds a day on these referral links. It looks like the dodgiest kind of concept because it was just a random link. You sign up to Timu and put all your information in, and then I think in the sort of terms and conditions it's like, oh, if you sign up here, we like own your likeness and we own all your data and we can select third parties and things like that. And I was just like, oh, that was this situation. I was like, oh, people might actually end up having a negative, I've made however many few easy quid by making people sign up to this service, but then who knows what that could happen with their data in the future. And I think that's kind of a stark contrast to what we're seeing here, in that it's just quite a simple idea, but one that will encourage people to sign up, and there doesn't really seem to be any drawbacks. Curve aren't going to go and steal your likeness and throw it on a billboard, although I won't guarantee anything like that because I haven't read the terms and conditions. But I think it's a good concept, and I think I like the initiative. And yeah, overall, I'm a fan of this type of news coming in.
Yeah, I think that's safe to assume that you won't just appear sort of on the high street one day. I do think that you're right, and I think just all in all, it is, well, like you were both saying, really, it is a really good initiative, and it just does go on to build trust, and that is a recurring theme that we see in the fintech industry, as fintechs are always sort of already fighting an uphill battle against the incumbents, but in doing this and in sort of securing customer loyalty, I think it is only a sign of good things to come, and it'll be interesting to see how impactful this really is for Curve and for its consumers, I think. But as tends to be the case with a lot of things we talk about on the podcast, time will only tell. We shall see. But yeah, why don't we go to you, Polly, for your article?
Yeah, absolutely. So this kind of does tie in kind of slightly to what we were just talking about. So essentially, Finotta has released a new white paper looking at evolving consumer preferences and what Gen Zs want in terms of their financial situation, and how that we can secure Gen Z loyalty. So the white paper is called "The Next Generation Financial Futures Redefined," and basically is exploring the distinct characteristics that set Gen Z apart from other generations, and offering solutions for finance institutions to help meet the Gen Z uh, consumers' unique needs. And I thought this was a really interesting thing to bring up today, because I think obviously, like we're just talking about consumer demands and consumer needs, and they're kind of fueling the industry. But I thought this was really interesting lens to look at it from, because I think we see a lot at the moment of people looking towards the future of finance and what the future of payments is going to be, like we talked about with embedded finance before, how that's going to affect things. And I think what a lot of the time we do need to remember is that things have changed so much in terms of the consumer. And the consumer here, as I was saying in the other article, that the consumer is still really key. And I think that's going to be a key thing for businesses and companies, regardless of whether they're a financial or a fintech or not, to look at. But I thought it was really interesting that Finotta have kind of like thought about this and brought out the white paper. And some of the things that they found that Gen Z sort of prioritize very differently to other people. So they prioritize financial wellness over personal wellness. So there's a significant market for products and services that cater to financial health and literacy, with digital transformation being a non-negotiable for engaging with this generation. And the big a big and there's also a big push in terms of personalized guidance and financial education, which I thought again was really interesting, because obviously we've talked about that so many times before. And I think the way that consumers are presenting themselves has changed so much. Like if you look at a Gen Z compared to like a boomer or a Gen X, they're so different in so many different ways. Not because obviously just the age thing, but like think of the the way that they've grown up. Gen Zs have grown up in a very digital first world. Everything's online for them. Everything is digital for them. Whereas obviously other generations wouldn't have had that. And the same thing goes, I think, in terms of, the different types of people that they are. I think Gen Z's generally, and this is quite a generalization, but generally speaking, they're kind of a little more cautious, which I think you can see here in terms of them wanting the financial education. They want the financial wellness. And so I just thought this was really interesting because obviously a lot of banks and a lot of finance companies and credit unions and whatever are really going to have to adapt to this new customer, because if we're talking about the future, it be them. Like, there's no point kind of trying to, obviously you want to serve all of your customers no matter what generation, no matter what age they are, but at the end of the day, the Gen Z and younger are the consumers that are going to be the future, and they're the consumers that you really are going to have to look to if you want your business to survive, especially when you consider how much um how much spending power Gen Zs are going to have, and the ball is in their court really when it comes to banking preferences and behavior. But they found that they are projected to have a purchasing power of $33 trillion by 2030, making up 25% of the workforce, which is such significant numbers. So it's so important that these companies need to attract and retain these customers now while they can. So I wanted to put it to you guys. Obviously, I believe you're both Gen Z. I think I'm a millennial just, and you guys, I believe, are Gen Z. So I'd obviously, from that lens as well, I'd love to know what you guys think about this. Like, is this something that financial institutions really need to start looking to in terms of trying to keep the Gen Z customers happy and doing a digital first and financial well-being? Is that really what we're going to see in the future of finance? Francis, I'll go to you first.
In short, I think so. I think if a financial institution is sort of saying we are cash first and we will remain cash first, while we always do love to say cash is king, I think that is a very sort of naive way to look at it, because consumer preferences are changing. People want to have, I mean, we talk about it all the time when, you have different payment options, and you have digital, you have crypto, you have, cards, or you have cash. There's so many different ways to pay. And I think that is something that we're going to continue to see a lot of organizations really prioritize and make sure that they are, like you just said then, catering to make sure they are catering to everyone. But I think it does relate very nicely to one of the topics brought up in Tom's article by Nirav Patel, the CEO of Endaria, who was talking about how traditional banks or incumbents really need to adopt technology in order to catch up, and embedded finance is one of those ways in which they can do so. And I think that will really cater to sort of the Gen Z population, as they're going to sort of see the digital adoptions, and they're going to be more inclined to transact, I suppose, with organizations that do have this digital first mentality. And because of that, I think it is a really, really important thing that, like you said, Polly, it really is a case of this is the future. This is the survival of your company. If you're not tailoring for the next 10, 20 years, I mean, of course, the payment preferences are going to change in that time, but you're already shooting yourself in the foot if you're not going to at least cater to them now. So, yeah, I think it is sort of, as the article points out, of the utmost importance. And there's so much room for organizations really to capitalize on it that incumbents especially would be really silly not to.
Yeah, you're absolutely right. I think there's a lot of that. And I think it's interesting you bring up the idea of incumbents, because I do think that they are the companies and the businesses that are really getting it right at the moment. Because I feel like if you think literally just in terms of like challenger banks like Starling, Monzo, and ones like that, pretty much everyone I know who is, under the ages of like 28 has an account with one of these digital banks, and they will use that as their main account. So I think it's really interesting that challengers are there, that are making the waves here, and it is where incumbents need to catch up and really sort of start thinking this is what we need to do. But I mean, like, Tom, what do you think?
I think this is another sort of situation where, like I said in the first article, and kind of like you alluded to there, was the sort of digital first options have done so well in garnering a lot of trust, particularly among Gen Z. And, the likes of Monzo have become especially prominent, in that sort of age group. And I wonder if, for the first time, like we were saying, incumbent banks sort of entering embedded finance, And in that case, because they sort of have the trust of a huge proportion of the sort of population, they're going to be immediately coming to the forefront as soon as they offer this type of solution. They're generally the type of name that people go, oh, I'll just go with their offering that's similar to the sort of digital first offerings, because I know them, I know Barclays, I know HSBC, and I want to sort of go with that option. But I wonder if maybe Gen Z and is it Gen Alpha afterwards, they're sort of in the next 4 or 5 years will start kind of coming into being old enough to sort of have their own say in this type of arena as well. But I think it might be the first kind of case where the likes of Monzo and Starlin have actually garnered enough trust to retain their audience. And sort of like this is saying, is that those digital first offerings are hugely important. And whether we might see in 10 years' time, actually the digital first banks starting to dominate the sort of trust that we talk about so much. And it'll be an interesting space to keep an eye on and see how these incumbent banks do basically try and stay at the forefront, and if they're going to need some drastic change, which I feel like eventually they're going to need to be in order to become as digital first as sort of their competitors.
Yeah, absolutely. I think you're absolutely right there. And it's one of those situations where it's like, oh, we just need to wait and see what happens. But I guess things are evolving so much all the time within fintech and within finance. So I think just as a general rule for companies to not being kind of mindful of that evolution is where they're going to fall down. So I think looking towards the future and looking at a focus on the younger generations, I think is really going to be beneficial. But anyway, thank you guys so much for bringing those articles to the table today. If you want to hear any more about anything we've talked about today or anything else from the Fintech Times, head on over to thefintechtimes.com, where there are plenty more news and insights on the fintech world over there. But very quickly, let's do what I learned this week. So each week we like to share some information that we learned because we hear so much being on the Fintech Times editorial team. We thought it'd be fun to share that with our listeners. So Tom, what have you learned this week?
This week I learnt that new data from the payments processor Fred found that 60% of online travel agencies struggle to find qualified payment partners with the necessary expertise to support and guide them.
Very interesting. And Francis, what have you learned this week?
So this week we always talk about consumer awareness, and especially in terms of security, that there really needs to be an onus on consumers to protect themselves. Well, research from CyberSafe has found that 85% of consumers felt that it was important for their banks to offer training about staying safe online and avoiding scams, and therefore it shows them taking initiative. So I thought that was quite interesting.
Great stuff. And then what I learned this week is how crazy e-wallets are going in the Philippines. And it is expected that by 2025, the country will surpass 80 million registered e-wallet accounts, which it will be a threefold increase within 5 years, which I thought was really interesting. But anyway, guys, thank you so much for joining me once again this week. It is a pleasure to have you as always. And yeah, so have a great week, and I'll catch you on the next one.
See you guys next week.
See you guys then.
Thanks for listening to the Fintech Times News and Views podcast. Don't miss next week's episode and continue the conversation using hashtag TFT News and Views and follow us at the Fintech Times.